Good afternoon and welcome to the Venture Life Group PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. And I'd now like to hand you over to Joe Randall, CEO. Good afternoon to you, sir.
Thanks, Alessandro. Good afternoon, everyone. Thank you for joining us on our Investor Meet presentation. Very happy to present to you today. As you know, we'll run through the slides that are on the screen. We've got some questions that have been submitted before, which we'll answer, and obviously we'll answer any others that come up on the chat room. Welcome to the presentation. We're going to start on slide 3. This gives an overall view of the key financial metrics for the first half of 2022. Danny's going to go through this in a bit more detail later on in the presentation, but I can just give you the flavour, if you like, of that first half. So if we start on the top left, you can see group revenue growth. These bars across the screen are all half years. We've taken out the one-off large hand sanitizer gel sales in 2020 because that distorts the overall path and showing you here what is the underlying business. And you can see we've got 36% revenue growth in the first half of 22 compared with the first half of 21. And this is driven from the acquisitions that we've made in 2021, BBI Healthcare and the assets from the Helsing Group. Okay, I've just seen a message saying there's a lot of echo. Is that a problem, Alessandro? Can you hear us okay?
I can hear you fine. I will monitor it and let you know if we need to change anything.
Okay, thank you. So these acquisitions made last year, they've been in growth, 9.5% growth year on year. The rest of the business prior to the acquisitions is relatively flat, but we'll have a much bigger second half of the year, which I'll talk about later because the revenues are weighted to the second half. The acquisitions that we made last year and how they've added to revenue has given a consequent boost in gross margin in two respects. The acquisitions were higher gross margin assets than our overall business when we acquired them, so that's contributed. Also, they've contributed in additive terms, in terms of pound notes. You can see we've got a good increase in gross margin pound note terms, but also in percentage terms. Our gross margin percentage has increased 5 percentage points compared to the first half of 2021. And again, Danny will walk through a gross margin bridge later to explain that. That's dropped through to obviously growth in EBITDA on the right-hand side. And if I go to the bottom row, on the left-hand side, you can see the first half has continued the increasing revenue mix of the Venture Life brands. These are the brands and the products with higher gross margins. So again, the strategy of the group has always been to grow the Venture Life brands because they bring greater gross margin. But the customer brands business also is growing. It has grown in the first half. It will grow very well in the second half as well. And that's part of the dual strategy of our product placement in terms of both brands and both customer brands. The middle graph at the bottom, you can see the performance of the acquired businesses, BBI and the Helsing assets, in 2022. And as I said, they grew overall 9.5% in the period compared to prior years, and we'll talk through those as we go through. And the final graph on the right-hand side, we're talking to cash generation. You'll see there's been a strong swing between what we saw in the first half of 21 to the first half of 22, 2.3 million swing, which is very positive, but also that's after movements in working capital. And as we'll talk to as we go through the presentation, supply chain and inventory build has been deducted in arriving at the cash generation. So with a nearly £2 million inventory build in the first half as well, which has been accounted for in arriving at that cash generation, you can see that we've got very good cash generation in the first half of the year. We'll go on to the next slide now. So just to talk about some of the flavour of that first half, we've covered some of these points already. So good impact from the acquisitions, delivering increased gross margin and EBITDA. We have a strong order book coming into the second half of the year, comfortably ahead at the same time last year, about 20 to 30% ahead on a growth basis. What that means is if you look at our business overall and our revenues overall, about 30% of our revenues are direct into the UK and the Netherlands, where we sell directly into retailers. The other 70% goes to partners who order their products, and we make their products to order. So UK and Netherlands, we hold stock. Retailers will draw that stock down as they need it. So Boots, Tesco's, Croydon, Superdrug, all those. The rest of the group, they place an order, we confirm that order, we manufacture, and then we deliver. So that order book, which relates to about 70% of our business, is well ahead for the year. Also, we have on top of that an increase in our order book relating to people ordering further forward, so customers ordering further ahead normally, and this is down to the supply chain issue. So as you will know, following our business and others, supply chain has been very difficult in the last 12 to 18 months. The biggest concern for our customers at the moment is availability rather than cost. So you'll see in the gross margin bridge later that we have managed to pass on most of the costs, direct costs that have increased for us in the cost of goods, and that's just customers want availability. So we've asked them to order further ahead when we're making to order. So normally, prior to these times, we would have asked them to order ahead 3 months, maybe 4 months ahead. Now we're asking to order 6 to 9 months ahead. And this has had two impacts, really. First thing is, it enables us to buy inventory forward where necessary to protect supply and protect price. Because with the very volatile supply chain situations we see at the moment, you can have prices changing daily, you can have suppliers having product one day and not the next. So we want to encourage customers to order earlier to make sure we can lock in price and confirm that with them, but also lock in availability. The second thing it does is give us much more visibility on the future. So our order book is now moving very well ahead into 2023 already, which is very different from last year. So very good, strong order book. That has resulted in us having a higher level of inventory, and Daniel will talk about that later in the financial section. But we think that's important to, as I say, keep customers supplied and keep costs under control for both them and us. We have lots of good revenue growth opportunities in the portfolio. We'll talk about those going forward through the presentation. Our new partner in China, we shipped stock to them at the start of the first half. They've now received that stock. It was stuck in the bonded warehouse in Shanghai during the lockdown. It's now come out and have started to sell. We have very limited expectations for this Chinese partner this year and into next year because of all the lockdowns, but we're hopeful, as many people are, that the zero COVID policy will be changed later this autumn in China, and that would open up that market more. So again, in the market numbers, very little from either analyst as regards to China business and for us ourselves, but I think in later in 23 and into 24, we'd expect to see good growth from this partner. We still have good capacity in the plant. We've been running at quite high levels of production through end of H1 and also into Q3, giving us good validation of the robustness and ability to deliver higher volumes. We still look at M&A opportunities, but obviously in the current environment, we're re-evaluating the use of an RCF at this time because of interest costs and leverage, but we'll have to consider perhaps M&A opportunities in a very different light, given the impact of the last 4 or 5 days. And our supply strategies will remain in place to protect gross margin and fulfil demand. I've just got one quick slide on the acquisitions in a bit more detail, just to show you their financial performance, and I'm going to hand over to Danny to talk through the overall finances. So as you can see here, 10% growth year on year in the BBI brands. So that is the Lift glucose product, the Glucagel glucose product, and the Balance Active bacterial vaginosis product. So Lift had very significant growth, 42%, driven mainly by increased activity in the relevant areas, plus a launch in Ireland. Balance Active underlying growth, about 5%. We did have a couple of negatives outside of that. We had a customer who was supplying to Russia, so we chose not to supply into Russia when the war started, and a small product on fertility gel, which was launched and in the UK did not do well, so we terminated that. But good opportunities in that portfolio and good growth, and we'll talk more specifically on the products and how they're performing later. The Helsing products that we acquired, 5% growth in those. These are entirely partnered products. We don't sell them direct to any retailers. So having acquired them, we're now looking to partner out in additional territories, particularly USA, Brazil and Canada. Big territories, we're quite advanced in discussions in those territories. So you'll see small growth from those assets this year, but as those new partnerships come in place, you'd expect to see stronger growth in 2023. And with that, I'll pass over to Danny, who'll talk about the financial overview in detail, and then you'll come back to me. I'll talk in a bit more detail about the brands and how they're performing.
Hi everyone, good afternoon. So just to emphasise a few of the key financial highlights to begin with, you can see we've done revenue growth of 36% year on year to 18.9 million. Now, of course, a large part of that revenue growth is the full 6 months impact of the BBI acquisition, which was acquired on 4th of June 2021. So there was 1 month of revenue last year and full 6 months this time around. But as Jerry's just touched on, we delivered 10% organic growth from that in the first half. That acquisition acquired new products to the group that were highly accretive to the gross margin profile in percentage terms, both on the BBI brands and the Helsinn brands, which were acquired in August 2021. These brands generate around 50% gross margin, which compares to more like 40% on the legacy DLG brands business. So very accretive to the group, and of course the customer brands generate a good margin also, but more around 30% on CDMO revenues, so from Italy. So much larger parts of the portfolio are higher margin brands now, driving that gross margin improvement to 14.6% in the first half. We have also achieved EBITDA growth of 71% on that, delivering 3.3 million EBITDA from 1.9 adjusted EBITDA in the first half of last year. So a lot of that gross margin flowing through to EBITDA with the BBI healthcare cost base coming in to the mix as well. And we'll talk more about administrative costs in a couple of slides' time, and resulting in an EBITDA percentage margin improvement, which is important. So we identified big cost synergies as part of the BBI acquisition particularly, and we've taken costs out of that business, brought in higher margin products, and we've seen an increase in the EBITDA percentage margin by 3.6% in the first half of the year compared to last year. And operating profit as well in the first half. So we delivered a £400,000 operating profit H1 of this year compared to a loss of £200,000 in the first half of last year. And that is after also incurring a significant increase in depreciation and amortization costs through the P&L following the acquisitions of BBI and Helsinn last year. So those acquisitions have had about a 1.2 million impact in increased depreciation and amortization costs in the first half of the year. So that operating profit, 400,000, is after absorbing that increased cost on the unwind of those assets. And as you can see on the bottom left-hand slide there, bottom left-hand chart, we're generating good cash from the business in the first half, 1.4 million net cash inflow compared to a negative 900,000 outflow in the previous year. So positive 2.3 million swing on cash generation in H1 22. And that's after absorbing some adverse working capital flux of around 1.3 million, which has predominantly been driven by the build in inventory that we have made a conscious decision to do in light of the need to secure supply early and mitigate cost pressures and secure components at a cost-effective price. I've just seen on the screen that there's a question about P&L impact of the weakening sterling. So I may as well address this one now. So across our group, the majority of our revenues are billed in euros, which is clearly helpful in light of what's happening with the pound at the moment. And we've got most of our costs as well are received in euros or incurred in euros in terms of material costs, packaging costs. We buy a lot of this from the continents. So we've got some natural hedging at play in the fact that our revenues and costs are largely euro denominated, and we have very little currency transacted in sterling. Transacted in US dollar, apologies. Very little US dollar exposure in the business right now, the way we are shaped at the moment. So we've got good natural hedging from euro, and the fact that euro is a heavy part of our international business, and we also see strong second half revenues from euro-denominated customers. We will get some nice tailwinds in the second half that will support or reduce our currency exposure across the group. And as we move forward, we're looking to professionalise our FX management further into the group. And we've recruited a new treasury manager a few months ago to start looking at that, looking at outside of just natural hedging, what other mechanisms can we put in place to ensure that our P&L is as best protected as it can be. But just to get to the final point on FX, on a constant currency basis, although our revenue was up 36% year on year on a reported basis, that was more like 35% on a constant currency basis. There is one other question. What was the growth of revenue H1 2022 versus H2 of 2021? Okay, so the revenue was flat, 18.9 million in the second half of last year. And in the first half of this year, we've done 18.9 million also. So revenue has stayed flat year on year. But if you look at the shape of the business over the last 18 months, you think first half of 2021 was 13.9 million. Second half of 21 was 18.9 million. The first half of this year was 18.9 again. And going into the second half of this year, we would expect a significant step up in our revenues, around 22 to 23 million to meet current market consensus out there with Singers and Sencos. And that is typical of the shape of our business as we go throughout the year, particularly on the international side of the business. A higher proportion of the revenues are weighted into the second half and particularly Q4 as those customers restock for the new year. We'll move on now to the revenue slide, which I think a few of you will have seen from us before. What we're depicting here is the evolution really of the revenue over a long period, looking at the split between customer brand revenues and VLG brand revenues. And by customer brand revenues, what I mean is the CDMO revenues served from our Italian manufacturing plants. And you can see those are the turquoise bar in the chart at the bottom. And those have grown year on year. It's around single-digit growth, good growth from that part of the business, and consistent, stable growth as well, as you can see, delivering around 30% gross margin. But it is the VLG brands, those charts in orange, the orange parts, that is our focus in terms of the growth story and building on the M&A that we've done and investing in the newly acquired brands. And you can see that that proportion of the VLG brands is increasing year on year over the period we're looking at here. And particularly the step up in 22 from 2021 is, of course, reflecting the impact of the acquisitions that have been made, a full 6 months of those. And we've also delivered organic growth from those acquisitions, and they're bringing accretive gross margin products or higher profitability products into our group, which are driving that GM percentage upwards. Just to further illustrate that, the shape of the business in a bit more simplicity here, what we're looking at is on the left-hand side of the page, we're looking at first half revenues in 2021, and you can see that 64% were those customer brand revenues in turquoise, so a bit lower margin, 30% gross margin. Whereas if we swing to the right-hand side of the slide, it's looking at the first half of this year, and now you can now see that VLG brands accounting for the larger share of the first half revenues, and those are the higher margin contributing products, which is therefore driving up again that gross margin percentage to labour the point a bit. In the pie chart in the middle, it's the second half of last year. And the reason we've shown that is that you can see there's quite a big shift change between second half revenue proportion of VLG brands compared to the first half of this year. 69% of second half revenues last year were VLG brands. And what that difference is really highlighting is the increase in the VLG international revenues, as we see strong second half orders from those customers as again they restock for the new year. And we've got great visibility over that due to our order book going out much further than it has done historically, and we've talked about that a bit in our statements. So we've got good visibility over second half VLG brand revenues increasing further, and that will also have a positive impact on the gross margin percentage as we move through the year. On the next slide, we're just looking a bit more detail around the individual elements of the sales underneath the VLG brands. So we're parking customer brands for a moment and we're focusing on the VLG brand revenues, which are the orange parts, the bars on the previous couple of slides. If I take you to the rectangle at the bottom of the page to begin with, you can see that we've set out what first half revenues by therapy area looks like. And the two biggest chunks of that were the diabetes management and women's healthcare products, which accounted for 55% of first half revenues. And these are products that treat genuine need states. Bacterial vaginosis, if you're suffering with this condition, you need to treat it. And similarly with diabetes, you need to regularly be able to treat that in a controlled manner. So we think we've got resilient products for genuine need states that leaves the business well positioned and well diversified in light of the current economic climate that we're facing right now. And looking at the chart at the top of the page, this is just an illustration simply of when you delve into that a bit further on a product by product basis, you can see that if I look at the left-hand side of that chart, the green bars are the first half revenues of this year, and the orange bars are the first half of last year. And you can see that Balance Active and Lift are now accounting for the largest proportion of the VLG brand's overall revenues. And what that's doing is because the margins on these products rather are 65% on Balance Active and around 48% on Lift. They are highly accretive to that legacy VLG brands portfolio, hence again driving up that GM percentage and in the overall roll-up of the numbers. I see the questions keep popping through. Perhaps we could take some of these at the end to make sure we get through the slide deck.
Yep.
So we'll come back to these. Thank you for your question. On to slide 12 now, just to build out that gross margin bridge in a bit more detail from last year, where we did 35.6% GM first half into 40.6% in the first half of this year. You can see that the biggest uplift in the margin is from the impact of the M&A. That drove a 6.25% positive impact, but that's not fully materialised in the overall number, as we've had some challenges, as you can see on the left-hand side of the slide. The supply chain piece, particularly around input prices to begin with, we've seen an adverse impact on costs by 1.45% in the first half, driven over packaging and raw materials. Predominantly on the packaging side, because the cost of energy has driven up the price of the packaging materials that we need to buy from our suppliers. On the raw material side, we have also had impact, but our procurement teams have done a good job of mitigating or limiting the impact of that by procuring smartly, so whether it be buying much further in advance in bulk loads, or reducing the number of shipments to get the products into our facilities, or by shipping by train rather than freight, for example. So we've taken some initiatives to minimise the impact of those input price increases. And if I take you to the orange bar in the middle of that slide, you can see there's a positive impact from customer CPI of 1.4%. Now, this is where we are passing those cost increases on to our customers throughout the first half of this year and also from the end of last year. So what we've done is, out of that 1.45, that first impact we've seen on input prices, we've passed on almost all of that 1.4% onto our customers. But what we've not yet been able to pass on, and we're exploring opportunities, is whether we can pass on some of this utility cost impact we've also seen. So on the utilities element of the chart, you can see 0.8% impact on GM. That is around £150,000 in increase of gas and energy costs year on year. And we're currently looking at opportunities, whether it be surcharges that we pass on to our customers, to try and minimise the impact on our own GM percentage. But as yet, that's not something that's in our first half numbers. Okay. Moving on to administrative costs now. So first half of last year, we incurred 4.5 million, and we spent 7 million in the first half of this year. Now, there's some key drivers of those increases. The first of those is the impact of the BBI Healthcare cost base coming into the business. So when that acquisition was made, 7-figure cost synergies were identified. And we executed a large part of those synergies at the end of last year and the beginning of this year. So that 0.5 million is the net impact of all of that. So predominantly that's the cost of running the site in Sweden and the team and overhead and infrastructure there, which is in the business now and will remain in the business as we go into the second half. So there's no further impact on that BBI cost base to come. On the A&P spend, we've invested more in our newly acquired brands, particularly on the Balance Active brand. We've launched into Germany in the first half of this year, and we've invested more in our A&P to support growth through UK retail bricks and mortar on that brand as well. On administrative costs, it's worth pointing out that out of that 0.6 million of overall cost increase, 0.2 of that is simply the impact of last year. We had a positive impact from releasing the Chinese bad debt provision into the P&L. So that benefit has not repeated in the first half of this year. So the real cash cost impact is 400,000 year on year, and that's reflecting investment across across the business, actually, in UK and Italy, predominantly in the commercial team. So we've invested in our e-commerce function, new brand managers, strengthened our international alliance team, and we've also invested in Italy as well to support the sales team and customer services side there to make sure the business is well placed to drive organic growth as we move forward with the new acquisitions we've made. We've also strengthened our finance team as well and brought in a couple of extra roles into the UK. Okay. And lastly on that slide, before I forget it, the non-cash items, just to highlight again, that is the depreciation and amortization costs I was mentioning earlier, so the impact of the acquisitions that were made last year, so it's a non-cash item. Last two slides on finance now. I'll just run you through the P&L. It's a quick summary of what we've just been talking about. So revenue growth of 36%, 18.9. Good gross profit growth of 55%, driving a margin improvement up by 5 percentage points to 40.6%. We've seen increased administrative costs driven by the BBI cost base, a bit more investment in our advertising and promotional, and ensuring that our wider commercial and finance teams across the business are well placed to manage future growth plans that we have. Overall, net of all of that, we've driven an EBITDA improvement of 71% to 3.3 million at a percentage margin improvement of 17.6% in total. More D&A because of the acquisitions, reduced exceptional costs because those acquisitions were last year, and we've delivered an operating profit of 400,000 in the first half compared to a loss of 200 in the previous year. And on the final slide on the balance sheet, I'll just talk to two rows of particular notes here. Firstly, 6 rows down the inventory row, you can see that inventory at the end of June was 11.5 million compared to 9.8 million on the 30th of June last year. So nearly a 2 million investment in that inventory because of the need to secure supply, secure materials to serve our order book. And we've got the ability to do that because we've got such good visibility going out well into H1 23 on our order book now, which is 2 or 3 months ahead of what we would have normally. So this has allowed us to protect the cost of the materials we're procuring or the packaging we're incurring. Otherwise, those percentage impacts on GM would have been larger than we presented today. But because of that inventory build, it has reduced our ability to bring down our overall gross debt a bit quicker. So if I take you to the second but last line on this balance sheet table, you can see net debt at the end of June was 3.1 million. That was 3.2 million at the end of December. So net debt has remained flat since the end of the year. We would have expected to come down to about 1 million by end of June, however, if it had not been for the investment in inventory. But we feel that that was the right thing to do, despite there being opportunity costs and capital costs tied up on that inventory. It is delivering a strong gross margin flow through to the P&L, which is a net positive impact for us. There's a few questions here.
We'll do it then.
We'll do the questions at the end, if that's okay. Thank you. Moving on to commercial injury.
Great, thanks very much, Danny. We've got a few slides here just talking about particularly the brands and how they're performing and what we're doing with those brands, but also on the customer brands part of the business, and then a little bit on ESG and our sustainability. So this first page is about the brands that we acquired from when we acquired the BBI business. So that includes the Lift product, which is a glucose product for a number of areas, but on recent research, what we found is this is being predominantly used by type 2 diabetics because it gives a measured dose of glucose, and also for people in sport and perhaps a sort of tiredness late working environment. Also, we have a product called Glucagel, which is a type 1 diabetics. It's a gel that's generally prescribed and reimbursed for placing on your gum for a type 1 diabetic who has a sudden hypoglycemic episode. And the third product was Balance Active, which you see at the bottom, which is for the treatment of bacterial vaginosis. So what we can see here is that the overall portfolio from BBI grew 10% like for like from the first half of this year compared to the first half of last year. And that was driven primarily by Lift. Lift grew 42% in the first half. And that came about through two aspects. The first was more people just out and about, whether it be sport, whether it be more activity, particularly for the type 2 diabetics needing portable or in a handbag, in the bag, products if they have a hypoglycemic episode, but also we signed a new partner in Ireland. That product has grown very well in the first half. We haven't invested significantly in that product in A&P this year because we've undertaken a lot of market research on who uses the product, and that will be shaping our brand plans for this for the next 3 years in particular. But that's a product where we see good growth. It's sold only in the UK and Ireland at the moment, and we'll look at the international expansion later. Balance Active, which is the bacterial vaginosis product, that's sold as in a long neck tube. You can see at the bottom there. The right-hand box is a box of 7. The left-hand box is a value pack that we're launching. It's going to be sold by one of the leading retailers later this year. And that puts 14 tubes in the same box. So the small box on the right, the regular pack, retails for £8.95. The large value pack, just twice as many tubes, will retail for £13.95. So helping consumers with some of the pressures they're feeling with prices. That'll be launched in a leading retailer. Also, as you may know, Balance Active is sold by Bayer under their Caniston brand and the Canis Balance brand name. And Bayer obviously trades on a premium brand of Caniston, and they sell 7 tubes. They sell that 7 tube box, and it retails around £14. So our value pack is a similar price to the Caniston main pack of 7, so double the amount of tubes. So we think that's a good offering. We think it brings value. On international markets, we've got 3 market launches with Bayer, including Brazil, where approval for Balance Active was achieved last year. We did have a couple of small negatives. So, as I mentioned earlier, customers supplying to Russia, we stopped supplying, and then the fertility gel products we discontinued that because it didn't perform very well in the UK. We did launch Balance Active in Germany on the Amazon platform. We've been very successful in the UK with the Amazon platform. That only launched 7 or 8 weeks ago. It's gaining traction, and we expect that to deliver good revenues, some of this year, but also into next year. Thanks, Danny. We're now going to talk about the oral care brands. Oral care brands, as you know, we've had for some time. There was a small decrease in these in the first half, and this is primarily down to the customer price increase we put through on the dental products. So this is where we sell them in the UK. As I mentioned earlier, about 30% of our revenues are in the UK, direct to retailers, and in that situation with a price increase, obviously you're putting it across the board to any retailer who's buying that product. We increased dental by 14%, very significant price increase. And dental hadn't had a price increase for a long time. And what we saw was a little bit of extra buying at the back end of 2021 because we had to notify retailers 3 months before the end of the year about this increase. So some of them took advantage of buying at a lower price before, and then in the first quarter, of 2022, some of them resisted that price increase and run their stocks down. But again, we held our ground. We had to put that price increase through, and they eventually bought. So that's what really contributed to that reduction, which, as I say, was made in the first quarter. And now it's back at the run rate that we would expect. We've lost no distribution in this, and particularly we've got more distribution. So dental, we're going to start selling a bit more of it in the discounters. There's a general move, I think, in retail for some consumers to be shopping more in the discounters. And by this, we don't mean Aldi Lidl, because their operating model means they just buy one-off orders of stock. It's what we call a wiggy, which is when it's gone, it's gone. They buy a set of product, they sell it, and then you don't know if they're going to come back for more. So by discounters, you mean the likes of Wilko, B&M, and those stores, and they have a longer-term relationship. Very pleased it's going back into Wilko, because just before we bought dental in 2018, it was delisted by Wilko, and we've got it back in there. Also, as you see towards the bottom of this slide, a leading retailer is expected to launch the product in Q4. That's another big grocery retailer, both dental and Ultradex, and again, gaining distribution. So overall, our feeling on the oral care brands is that they've held up well. The oral care market as a whole over the last 18 months has been roughly flat by value. It's a £1 billion market in the UK. About 80% of that is toothpaste, 20% is mouthwash. The toothpaste market has grown slightly, the mouthwash market has gone down, but against that, our brands have held relatively steady, so we're very happy with that. Moving on to the last slide on the products, and this covers the suite of products we acquired from Helsing last year for our quality support. That's Pommy Tea, which is a food supplement for the reduction of PSA, and Gel Clear, which is a mouth rinse for treating oral mucositis, which is a side effect of chemo radiotherapy to the head and neck. So overall, 5% growth in these brands. These are partner brands, so as I mentioned earlier, we're in the process of partnering them out in new territories, and that's where we see the majority of growth coming from. So Kpis, we've partnered in 3 new territories this year, and we'll expect to see orders beginning next year. Also, Gelclair, we're in active discussions in 3 sizable markets, USA, Brazil and Canada. The product was in the USA until 2020 under the previous ownership, but the company in the USA went into Chapter 11 during COVID. So now we're in active discussions with other USA distributors. It sold very well in the US. And in Brazil, we've recently got approval. Brazil's a big market, we're in discussions there. So this year quite quiet, just 5% increase so far. We'd expect to see more next year. Towards the bottom of the page, the customer brands business. This grew 3% in the first half, which was good results overall, but you'll see much stronger growth from this portfolio in the second half. Again, coming back to ordering patterns, customers returning to more normal levels of ordering compared to 2021, where there was a little bit of destocking that went on. But again, good performance there. We're seeing that from existing customers, we're seeing it from new customers. We mentioned Alpha Sigma and Accord, 2 new customers, Accord, the big US business, and Alpha Sigma is one of the larger private pharma companies in Italy. But also we're seeing good interest from existing and new customers who are having issues with their current suppliers, who are perhaps not managing the supply chain difficulties as well as we are, and so are unable to supply. So that won't really impact this year, but if we do take on some of those products, you'll see the benefit next year. Moving on just to our scalability, I just want to re-emphasise this. Those of you who know us will have seen this before, but the bars represent units of production in the millions, and the first bar on the left is what we produced in the last 12 months. In the turquoise is 26 million units, that's from our Italian facility, and in orange is 2 million units from the Swedish facility. The Swedish facility just makes the balanced acid product. And by 2 million units, we mean 2 million boxes, which each contain 7 tubes. So as you can see, the second bar there is our capacity currently, and you can see that we're running, just over half our overall capacity. We did have very significant production in June, July, August, and September in Italy, higher than we've had on a consistent basis ever before. And bear in mind, August is normally a very quiet sort of shutdown month. We didn't shut down, we kept producing based on customer orders, customer demand. And the plant held up very well. The production levels were very good, efficiencies were good, so very happy with that. We're undertaking a few initiatives in the next 12 months, investing in not Sweden but in Italy. Swedish plants are fully automated, very efficient, 270 tubes a minute go through that. Typically in Italy our lines run at 50 to 100 units a minute, but it's more labour intensive. So we're working on a bit more automation which will help us to make our labour usage more efficient in Italy and help manage any upward pressure we may see on labour costs. I've got a few slides now talking about our sustainability project, Sustainable Life. This is the project where we work to become much more visible and transparent with our stakeholders regarding our sustainability. We do quite a lot in the group already, but we haven't been particularly public about it. For example, in our plant in Italy, we make use of solar energy, heat recycling. We use closed water systems to help reduce our use of water, reduction in waste, reduction in packaging. So many things we do already, and now it's important that we become very visible and transparent with what we're doing. So we kicked this off at the back end of 21 when we picked a team, including myself and other members of the business, to begin to work on this project. We undertook stakeholder consultation in Q2, which included employees, customers, suppliers and shareholders. And on the basis of that, we've identified which of those Sustainable Development Goals published by the UN we're going to prioritise. They're all good goals, but of course each business can only, if you like, focus on some and influence some more than others. And from the feedback from our stakeholders, we've chosen those. And then we're going to be setting the KPIs against which we're going to measure the improvement in those areas and the baselines of those. And in our report accounts next year, we hope to publish the baseline KPI numbers, and then each reporting period, we will report against our progress against those. Moving on, before I go into which of those priority goals, Just a couple of related matters. So for our 2021 performance, we were awarded the sustainability rating of bronze by the EcoVadis consultancy. They're a consultancy that a number of our retail customers use to assess their suppliers, so Boots, Tesco's, etc. So very pleased to receive that. I don't have any data on whether that puts us in top half, top quartile, or whatever, but it is positive because the customers are very happy with that. We'll work obviously going forward to improve that. Also in 2023, we're going to be actively working towards achieving the B Corp status, because we know that's very important for visibly for a number of people, but also the standards that it sets you to are good standards to follow. And then finally on this, on the next slide, we've just set out here what we have identified as our priority sustainable development goals that we will be focusing on. I'm not going to sort of run through these or list these, you can see them here on the slide, but we'll be, as I say, identifying the correct KPIs in which to measure progress here, then measuring our baseline position and reporting our progress against those KPIs as we go forward. So very exciting project, embraced very well by everybody within the business and progressing. So I've just got a final slide really here, and then obviously we'll get on to answering the questions that have been asked. So if I look at the first half, it's good impact of the new acquired businesses which are growing in our hands. Legacy business was flat compared to previous year, but that's because revenues are much more weighted to the second half, and we have that. We see that through a very highly visible order book. Gross margin improvement of 5 percentage points, again, mainly due to the impact of the acquisitions, but also beginning to mitigate, measure and balance those gross margin pressures. Supply chain pressures do remain an issue. Like I said earlier, we're only just over the peak of the worst. They will continue, but we see them getting slightly better in the autumn and a bit better next year. Energy consumptive components are the ones where the issues will remain. So paper, card, glass, where a high level of the input costs are energy. So that will continue to be a pressure. But again, with our policy of holding good inventory forward and getting orders from customers forward, we can manage that. Good operating cash conversion in the first half. We expect that to continue, and that's even against the backdrop of an inventory build. So what do we see for H2? Well, as we said already, the legacy business will be stronger in the second half. Historic weighting, good visibility of the order book, supply chain management will continue. We'll keep the inventory where it is. We don't expect that to unwind because it's continuing forward-looking position with the order book. Good cash conversion, and on target to deliver our expectations for 2022. So that concludes our presentation. I think we're going to hand back to Alessandra to answer the questions that you've raised.
Jerry, Daniel, thank you very much for your presentation. And ladies and gentlemen, please do continue to submit your questions just using the Q&A tab situated in the top right-hand corner of your screen. And we received a number of pre-submitted questions from investors, and I wanted to start off the Q&A session with these. The first one reads as follows. In recent calls, you mentioned that new people had been hired to look after the relationship with Amazon, specifically for UK and German markets. Can you give an update on how that is progressing against plan, and what should we be looking over for the next 6 months?
Yes, of course. So we had a head of e-commerce that started the role in March 22, and that's enabled us to bring our e-commerce expertise in-house with using agencies before. Overall, as we said, the H1 performance is flat against the prior year, but with a lower overall investment. And consumers have started to return to bricks and mortar in H1 22 compared to H1 21. We've launched Amazon Germany, as we said. It's been operational since April. Sales continue to increase month on month. Well, at the same time, one of the KPIs we look at, which is take cost, which is the advertising cost per sale, is falling. So that in turn is driving higher profitability. It's still small and early, but we're very positive with that. And if we look at the next 6 to 12 months, there are line extensions in the German business where we've launched there, new product launches in the UK, market expansion across the EU, continued focus in driving efficiencies through our supply chain and Kpis spend. In addition, we're looking to expand into other key EU countries with the Amazon platform.
That's great. Thank you very much. The next question here reads as follows. In terms of overall headcount, How do you see that moving over the next 6 to 12 months? Do you need any specific hires for online transformation, product development, marketing, sales, etc.?
No, we've got all the right structure in place to cope with all of that. So we've got structure and people to cope with all of those aspects. And already, for example, NPD, marketing is already in-house, so we won't see additional resource being needed in those areas.
Thank you very much. What are the key KPIs you are tracking? Is there a long-term plan for the next 3 to 5 years for each brand or business line? How do you track progress on these plans/strategies?
Sure. As a leadership team, we have built and developed a 3-year plan, which goes out, included this year and 2 more years. And we have prepared detailed brand plans that go behind that. And then we have key KPIs. So the key KPIs, first of all, net revenue. Net revenue takes account the level of fixed and variable investment required to increase top-line sales. That's one of our such KPIs. The objective is to increase net revenue. So, for example, compared to gross revenue, net revenue would have deducted promotional. If we've got volume-related promotional costs, they'll be taken off of sales. So we make sure we take those off and measure net revenue as a real measure there. Gross margin, of course, that's really important at the moment on a brand and on a country basis. And overall in the business, we're looking at net revenue, gross margin, cash conversion. There are sort of 3 key KPIs. And progress against these plans and targets is monitored continuously, board meetings, cross-functional meetings, commercial finance, and across the sites.
Thank you, that's great. You mentioned in the recent update about increased inbound customer inquiries around own labels/customer brand leads. Should we expect some of these opportunities to come to fruition over the next 6 to 12 months? Will there be increased emphasis in this area, own brand/own manufacture for value, pharmacy and retail channels?
Sure, yeah. As I mentioned in the presentation, the inquiries, if someone inquires on us day one to develop and make a product for them, it's a 6 to 12 month process before we start delivering, depending on whether it's a cosmetic registration, a food supplement registration, or a medical device. So, yeah, those inquiries will come to fruition in terms of revenue in future years and not this year. There's a continued emphasis on the own brand area of the business. That business has more than doubled since we merged with it in 2014, and we see a really good, profitable level of business from there. We continue to expand those customers. I think it's a part of the business which contributes and significantly subsidises the costs of the factory and therefore the cost of the facility that makes our own brands. It spreads the overall costs in different volumes with lots of capacity. It's not limiting our ability to grow organically and build a brand. So we'll continue to develop that area. It's a very successful team in terms of bringing in new products, new developments. They do a fantastic job, and that continues to grow our overall base. Similarly, we start to see cross-pollination where some of these partners potentially look at our brands as well. So it's a good way of building our overall customer base.
Thank you very much. Are you able to give a steer as to when inventory load investment in Interim can start to be unwound? Is this something we can expect to still see well into next year?
Sure. So as you'll have seen from the investment we've made this with a conscious decision because of the order book. And probably going back 12, 15 weeks ago, we would have expected our order book, our inventory to unwind back to sort of 9 million by the end of this year, if not for the visibility we've got going out into H1 2023. So that won't happen now because we're procuring materials to ensure supply of H1 2023 revenues. So we would expect that for the end of this year, our inventory will still be around the 11.5 mark because we are still buying out into the first half of next year. But as we move into next year, at what point that will start to come down? We would expect that around Q1, as we serve a lot of our Q1 revenues, that we will start to see a decrease in that inventory level book and settling down around H1 of next year, so around June 23, we think that will come down to around the 10 million mark. So that's still higher than we have had as a benchmark historically. We've been around 8.5 to 9 million on inventory in recent years. So it is reflecting the fact we still are having to procure materials still in longer lead times than previously. However, that said, we do suspect to see there will be some wind down, just not at the same rate as we would have seen in previous years going into the first half of next year and the end of this year. So just to summarise that, we expect we'll be around 11 to 11.5 still by the end of this year because of next year's raw materials that we procured winding down from Q1 through to end of June next year.
Thank you very much. Understanding the current tough consumer spending / cost of living environment, are there any segments or country markets where you are seeing growth or strength?
Yeah, I mean, all of our products address a need state. Therefore, despite the challenges around the cost of living crisis, we believe there'll still be a need for our products. We are seeing strong growth, particularly in the diabetes energy management segment compared to last year, and we're seeing exceptional growth in the UK, particularly, and look to partner this in other markets internationally. On the oncology support gel there, we're seeing good demand for this product, given the strength of the product and the clinical studies. We expect to see growth from this in FY23, particularly in new key markets. Other markets, we're seeing good growth for niche tech products such as Procto-Eze for hemorrhoids in Austria and other women's health products in Greece and other countries, and oral care in general. So, we haven't seen any particular dampening of demand, and we're seeing good demand for a lot of our products.
Thank you very much for that. China and Samarkand, understand this has been a slow burn, what with supply chain and COVID lockdown restrictions there, but what will the next milestones be there, assuming it will be next year before we start to expect progress? What kind of promotion is Samarkand currently able to undertake for the dental brands?
Sure, I mean, there are ongoing lockdowns in China, obviously at the moment Chengdu, and there are other provinces with restricted COVID measures, for example Shenzhen. And all of this is adding to the continuing uncertainty and low sort of consumer confidence. But next year will be a key year for that partner, provided that lockdowns are over and consumer confidence is returning. The next milestones will be November, the 11/11 event. It's a big sales event in China, usually gives us a good indication of how the brands are performing. Dental is sold predominantly online. Promotions will be price-based or what they call GWP, gift with purchase, which is very common in China. And these brands are being promoted by key influencers on social media, and almost all of their marketing is being done digitally. So, yeah, I think that the simple answer is it's a slow burn at the moment, but we do expect it to pick up next year with those changes we hope.
That's great. And maybe the final pre-submitted question here. For the new in-market product launches, are you able to give any colour on how those are progressing and which ones you most excited about over the next 12 months?
Yeah, I mean, these new launches haven't yet launched, but we've secured the distributor and preparing for launch, so we expect them to launch October, November. And we can't give away too much as it's commercially sensitive, and the nature of some of these new products and our NPD. But the NPD, we have a balance active, it's exciting. We've already talked about that, the multi-pack, and that will help to build the brand. Plus, as we've said, within the balance active category, the launch of a thrush product, again, is positive. So those, I think, are the exciting ones for the next 12 months. I think, as I mentioned earlier, the oncology support business and the partnerships we're doing there will also see launches in the coming year.
That's great. Thank you very much. And as you can see, we've also received a number of questions throughout today's live event. And I know we've already dealt with a few questions during the presentation, but if I could just ask you to read out the questions and give responses where it's appropriate to do so, then I'll pick up from you both at the end.
Okay, sure. Yeah, I'm happy to answer these. We've got some more time.
I'll take the first one.
Yeah. Danny's going to answer the first one.
I'll take the first one. So I think we covered segmental sales partly since this question was raised. Just to summarise, we've seen that the new acquisitions, BBI delivered 10% growth organically, Helsing delivered 5% growth organically, and then the customer brands business also delivered growth of around 5%. But overall, the rest of the legacy business was slightly down by about 200k versus the previous year, so about 1.5%. So good organic growth coming through on new brands and new acquisitions, customer brands growing, slight softness in the rest of the legacy business on the UK side in the first half, but we've got strong visibility of the second half international revenues that will pick that back up into growth.
Okay. Yeah, excellent. This is a question, which product do you think could add most materially to revenue growth over the next 18 months, and what is driving the growth? I think, as we've mentioned already, I think Balance Active is one of the ones we think will have significant growth. So the new product development and multi-pack going through the retailer in the UK, the launch of in Germany on Amazon, the thrush product coming to market, the expansion of territories, and the following of the Bayer launches, because the agreement we have with Bayer is as they launch Kpis Balance in new territories, we're allowed to launch Balance Active in those same territories as well. So I think Balance Active has really good material revenue impact going forward. Similarly, Lift, we've seen really strong growth in Lift, and we haven't actually invested much money behind it. So I think they're two of the big drivers. And I think sort of the third one will be those oncology products that we bought from Helsing, because as I say, they're being partnered at the moment, and the revenues will come in future years. Okay, we'll go on to the next question now. Happy to answer. 25% vote against by shareholders at AGM reissue of share resolutions. Any further colour on why such a significant vote against? Yeah, it's a bit disappointing, but I do have some colour on that. I think, unfortunately, only I think just under a third of our shareholders voted. So I think that's, personally, it's a bit disappointing, because obviously shareholders have a chance once a year to give us their thoughts, and only 2/3 did. That predominantly covered our institutional shareholders, obviously plus management, and I suspect a small number of retail shareholders. So actually the votes against only represented 17% of our overall shares. It's just that because only 2/3 of the shares voted, then it represented 25%. It was only just over 25%, and in fact it was two institutional shareholders, one of whom is no longer on the register. So I can't give you any colour as to why they made that vote. I suspect it was because they like to have a say in whether we issue shares for cash. Obviously, we're entitled under the resolutions to issue shares for non-cash consideration. Of course, at the moment, we wouldn't consider any issue of shares at the current share price. But yeah, I can't really comment on their views, but it was only one shareholder. All of our other institutional shareholders fully supported all of the resolutions at the meeting. Next question. Share price at all-time low. Do you feel vulnerable to a takeover offer? No, we don't. And I think there's two reasons for that. I think the first reason is we have a good supportive shareholder base. Obviously, at the time of results like this, I go and meet all of our major shareholders with Danny, and we talk to them. So good supportive shareholder base. We're not aware of any further institutional sellers. There's a question that's come up later, but I can deal with it at the same point, where someone was asking if there was an overhang of shares. You would have seen on Thursday of last week, on the day of our results, there was significant volume. That was clearing out of an institutional shareholder. It was that one I referred to who voted against, as we believe, voted against the share issue resolution. That shareholder's now been cleared out. All the stock was bought by one of our other shareholders. And I'm not aware of any overhang, certainly from an institutional basis, and volumes in recent days have been very low. Again, picking up a question from the question originally, which was about, are we vulnerable to takeover? No, I don't believe we are, because the institutional shareholders are supportive. They remain a significant proportion of our shareholder base, well over 60% is institutional. The share price is very low compared to the last fundraising. The shareholders believe there's significant value in the business, and it's not represented by the current share price, which is obviously driven by market sentiment, not by underlying value. On our market expectations this year to deliver around 8.5 million of EBITDA profit. Even on a 10 times multiple, that puts you at 85 million, which is 60 or 70p share price. So certainly my feedback from shareholders is they think the shares are worth a lot more now, and they wouldn't be interested. I don't think in any precipitous takeover. Me as a management team wouldn't. Business is substantially undervalued. There's lots of growth in the business. We're big holders ourselves. So no, we don't feel vulnerable this time.
Okay.
Do you want to do that?
Yeah, sure. Yeah. So does the recent decline of sterling give you any issues with UK trade, where your revenues are in GBP, yet your COGS are in euros? And how will you hedge this? So in short, the answer is yes, it does put pressure on margins if we're buying goods in euros and selling them in sterling through the UK trade. So what are we doing about it? There's three main things we're doing. The first one is that we've actually started to look at locking in euro rates with our bankers. when we buy goods from our intercompany based sites in Italy and the Netherlands. So we're trying to protect the FX rate that we will get at the point when we know we'll have to pay those invoices. So there's some activity that we're exploring now. We did our first one about a month ago, and we're continuing to look at this harder with the investment in our new treasury manager and professionalising the FX function. So that's the specific FX element that we're looking at to try and mitigate that impact. But there are other elements that we are working on outside of pure FX management to help mitigate the impact that this FX issue is having on the gross margin in the UK. So the first of those is that we see there's lots more CPI, cost price increase opportunity / necessity for some of our key products into the UK market where no CPI has yet been passed on, and we see that there is real and validated opportunity to do that, and we're looking at that at the moment. So potential further CPI, which will help mitigate the impact that small impact FX has had or is having at the moment based on the rate movement we've seen. But also, as part of our strategy, we're continuing to look to internalise more production throughout the business and reduce the any outsourcing we have. So some of our products are still manufactured by CMOs, so outside of our Swedish and Italian facilities, we do have other suppliers, and we're looking at feasibility studies to bring those products in-house and therefore generate more margin ourselves by reducing the cost of goods to produce those products in the first place. So some directly FX-related actions and some indirect actions to help mitigate the impact of FX that's going through the UK trade as a result of recent rate movements.
I think the other thing on that as well is we do have a number of backup suppliers in the UK for our UK products, and I think if sterling were to deteriorate too far, we can switch core production into there if it protects our margins if there's an issue. I think we've got probably time for one more question. So what other, how many more have we got? Okay, we've got time probably just for one or two more questions. So Danny, do you want to deal with, that question about balance active?
Yeah, sure. So there's a question here. Do you have any plans to take balance active and lift into the US? We're actually already in the US for both of these products, but in a very soft way. We're launched online on Amazon and have been for around 12 to 15 months now. But those we're not putting much investment behind those products at the moment, as we've been looking to do a reset on price and strategy for that market and a wider competitive benchmark assessment of the landscape in the US. So we certainly have more plans to drive growth through the US, but at this moment in time, we're just re-evaluating the competitive landscape before putting a bit more A&P back into that online launch initially, and also looking at other online platforms in the US, such as Walmart.com, to further roll those products out with the aim of ultimately getting a bricks and mortar listing, having shown success online. So that's a work in progress, but currently only a low level investment being put behind it.
So there's a question on the chair as well, isn't there?
Yes.
Yeah, so there's a question, what changes has the new chairman made to the business? So Paul McGreevy joined us in May. Paul's a very experienced commercial operator. For those who don't know, but he was instrumental in the expansion of the Body Shop business all the way across Europe. He's involved in a number of businesses in the consumer space, consumer product space, beauty, and also healthcare, and significant experience in the Far East in terms of manufacturing and supply. Paul's been very good in helping us on a practical basis with sourcing more materials from the Far East, where we may have had issues over here. Interest is far lower in the Far East, electricity costs are lower, so he's helped us with that. He's brought good rigour into the board, so we're spending a lot of time in the board on commercial aspects, strategy, growth plans, and particularly the brand plans going forward. He's introduced a risk ledger into the business, which we were doing informally before, but now formally at each board meeting we discuss that risk ledger, look at the risk both to the business and also the financial aspects of the business and how we manage those. So yeah, very, very happy with that. You will also have seen that we indicated to the market during the summer that two of our non-execs will be stepping down through rotation. We've been active in that process. We've identified the replacement candidates who are going through the final diligence from our side at the moment, and there'll be some news about that in due course. I think Probably that's all we've got time for, if that's okay. If there are any remaining questions on there, we're very happy, obviously, we'll put written answers up for that in due course. But thank you for your time and the questions today.
Jerry, Daniel, thank you very much for that. I think you've addressed those questions you can from investors. And of course, the company will review all questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Jerry, could I just ask you for a few closing comments?
Yes, of course. It's a very difficult operating environment. I think supply chain has been the worst I've experienced in my business life. But I think the team, particularly in Italy and our facilities there, across the group, have worked really well to manage those. If we go back, let's say, a year, 2 years ago, supply chain issues, you might get a price change once every few weeks. Now, prices are changing daily, supply availability is changing daily. We have to find additional suppliers, replacement suppliers, even reformulate products here and there to improve. So a very challenging environment, and the team's done brilliantly in dealing with it. I think aside the first half, the order book's strong into the second half. We're very comfortable on our year-end numbers. We see good robustness in the business and the debt and good growing customers. So yes, it's I'm sure it's frustrating the shareholders to see the share price is. I think they'll see that across all of their holdings at the moment, but the business is in really good shape, significantly undervalued at the moment on the capital markets. But I'm sure that as the markets come back and recognise the value of the business, that will revert. So thank you for your support and thank you for your questions. We're also very happy here if any of you want to ring in or email in at any time to ask questions. We're very happy to speak to you, meet you, or answer those questions. So again, thank you for your time and support, and best wishes in these volatile times.
Jerry, Daniel, thank you very much for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Venture Life Group PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.